Most people believe crypto markets are driven primarily by technology, regulation, or innovation. Yet when you zoom out and study the emotional rhythm behind every major crypto cycle, a different pattern begins to emerge. Because the largest movements are often less about code and more about human psychology reacting to uncertainty, opportunity, fear, and social proof. A person can enter the crypto market believing they are making a rational investment decision, only to discover weeks later that their behavior has slowly become emotional, reactive, and identity driven, without them fully noticing the shift happening inside their own mind. This pattern is repeated across nearly every major crypto cycle over the past decade. During the early stages of a market rise, participation usually begins quietly among technically curious individuals, long-term believers, and high-risk investors who are comfortable operating in uncertainty. Prices move slowly at first. Media attention remains limited, and public skepticism is still dominant. At this stage, emotional intensity stays relatively low because expectations are restrained and social validation is minimal. Most people observing from the outside still consider crypto too risky, too confusing, or too unstable to deserve serious attention. Then something subtle begins to change. Prices rise steadily enough for conversations to spread beyond niche internet communities and into mainstream social spaces, workplaces, family discussions, podcasts, and financial media. Human beings naturally pay attention to social momentum because the brain interprets group movement as informational safety. When many people suddenly appear interested in the same asset, individuals begin assuming that collective behavior itself must contain hidden knowledge. This is where emotional investing slowly accelerates, because curiosity transforms into comparison, and comparison transforms into urgency. A person who ignored crypto for years may suddenly experience emotional discomfort after hearing repeated stories of gains from friends, co-workers, or online personalities. The discomfort is not always greed in the traditional sense. Often it is psychological exclusion. Humans are deeply sensitive to the feeling of being left behind while others appear to advance financially. Behavioral economists sometimes describe this as relative positioning psychology, where satisfaction is measured less by absolute outcomes and more by perceived movement compared to surrounding peers. In crypto markets, this emotional mechanism becomes amplified because price appreciation can happen unusually fast, creating dramatic social contrasts within short periods of time. As more participants enter, the market begins transitioning from analysis-driven behavior toward narrative-driven behavior. At this stage, investors are no longer purchasing assets purely because of technical utility or long-term adoption models. They begin purchasing stories. One coin represents financial independence. Another represents rebellion against traditional banking. Another symbolizes technological revolution, while others become associated with internet culture, community identity, or speculative optimism. The stronger the narrative becomes, the less attention participants often pay to valuation discipline or risk exposure. This transition matters because human beings are emotional storytellers before they are rational statisticians. Neuroscience research consistently shows that emotionally engaging narratives influence decision-making more powerfully than raw numerical information. In crypto markets, narratives spread at internet speed through short videos, social feeds, memes, influencers, and algorithm-driven recommendation systems. The result is a financial environment where emotional contagion travels faster than careful analysis. Once emotional contagion dominates, volatility itself begins reinforcing emotional behavior. Rising prices generate excitement. Excitement attracts new participants. New participants push prices higher. And higher prices create stronger emotional conviction among existing holders. This feedback loop can temporarily create the illusion that risk has disappeared. Investors who previously considered themselves cautious may suddenly increase position sizes, borrow money, or abandon diversification principles, because repeated market gains psychologically reduce perceived danger. Historically, similar emotional cycles have appeared long before crypto existed. During the Dutch tulip mania in the 17th century, rare tulip bulbs transformed from luxury botanical items into speculative social assets whose prices detached from ordinary valuation logic. During the dot-com bubble of the late 1990s, internet-related companies attracted enormous capital flows driven partly by legitimate technological innovation and partly by emotional excitement surrounding a transformative new era. In both cases, the underlying technology or asset class was not entirely meaningless. The emotional acceleration surrounding them simply exceeded rational pricing discipline. Crypto markets compress these emotional cycles into much shorter timelines because digital communication moves globally within seconds. A rumor, tweet, regulation headline, celebrity endorsement, or exchange failure can influence millions of participants simultaneously. Traditional markets also react emotionally, but crypto operates continuously without closing hours, allowing fear and euphoria to circulate almost nonstop across global time zones. This creates an environment where emotional exhaustion becomes common among active participants. One of the most powerful psychological forces in crypto investing is intermittent reinforcement, a mechanism heavily studied in behavioral psychology. Slot machines use intermittent rewards because unpredictable outcomes create stronger behavioral attachment than predictable ones. Crypto markets often produce a similar emotional structure. An investor may experience several losses followed by one dramatic gain large enough to emotionally outweigh prior negative experiences. This unpredictability keeps participants psychologically engaged even during volatile downturns. Social media intensifies the effect because people rarely broadcast ordinary outcomes. During bullish periods, timelines become saturated with screenshots of profits, success stories, and optimistic forecasts. Losses remain less visible. The human brain then develops distorted probability assumptions because it overestimates how common extraordinary gains actually are. This phenomenon, known as availability bias, causes emotionally charged examples to dominate perception, even when statistical reality is less dramatic. At the same time, identity formation begins shaping investor behavior. Some individuals no longer see themselves merely as investors holding an asset. They begin identifying personally with specific crypto communities, technologies, or ideological movements. Once financial decisions become connected to personal identity, objective analysis becomes more difficult because criticism of the asset starts feeling psychologically similar to criticism of the self. This explains why online crypto discussions can sometimes resemble tribal conflicts more than financial debates. The emotional peak of a crypto cycle usually arrives when optimism becomes culturally normalized. At this point, skepticism appears outdated. Caution feels emotionally uncomfortable. And future price increases start being treated as inevitable. Historically, This phase often attracts the largest wave of inexperienced participants because mainstream confidence reduces perceived risk. Ironically, the moment an asset feels emotionally safest is frequently the moment financial risk becomes structurally highest. Then the cycle reverses. Sometimes the trigger is regulation, liquidity tightening, macroeconomic pressure, exchange instability, fraud exposure, or simply exhausted buying momentum. Prices begin falling, initially treated as temporary corrections. But as declines deepen, emotional certainty weakens. Investors who previously ignored risk suddenly become hyper-aware of it. Optimism transitions into anxiety, then denial, then fear. Participants who entered near market peaks experience not only financial pressure, but emotional shock because their imagined future suddenly disconnects from present reality. Losses feel psychologically heavier than gains because of loss aversion, one of the most documented principles in behavioral economics. Research repeatedly shows that humans experience the emotional pain of losses more intensely than the pleasure of equivalent gains. In crypto markets, where volatility can be extreme, this emotional asymmetry becomes amplified. People who tolerated massive risk during euphoric periods may suddenly sell during panic conditions, simply to escape emotional discomfort. This creates the second emotional feedback loop. Falling prices increase fear. Fear accelerates selling. Selling pushes prices lower. And lower prices reinforce collective pessimism. During severe downturns, the exact same social systems that amplified optimism begin amplifying despair. Media headlines shift from revolutionary opportunity to collapsed narratives. Online discussions become cynical. Confidence disappears faster than it originally formed. Yet over long periods, crypto markets repeatedly demonstrate a remarkable psychological reset. After major declines, public interest fades, emotional intensity cools, speculation decreases, and surviving participants gradually return to analytical thinking. Builders continue developing infrastructure quietly while public attention moves elsewhere. Then eventually, a new technological breakthrough, liquidity cycle, macroeconomic shift, or social narrative restarts the emotional engine once again. Understanding this cycle does not require believing crypto is either perfect or worthless. The deeper lesson is that financial markets are emotional systems built on human perception as much as economic fundamentals. Crypto simply exposes these emotional mechanics more visibly and more rapidly than many traditional assets, because the environment is decentralized, highly social, globally connected, and structurally volatile. The investors who tend to survive across multiple cycles are often not the people with the highest intelligence or the fastest reactions, but the individuals who develop emotional awareness around their own behavior. They recognize when excitement is influencing risk perception, when fear is distorting judgment, and when social momentum is replacing independent analysis. They understand that emotional discipline matters just as much as technical knowledge. Over time, the crypto market becomes less of a technology lesson and more of a mirror reflecting human behavior under uncertainty. Every cycle reveals how strongly people desire financial freedom, how quickly crowds form around optimism, how fear spreads through interconnected systems, and how difficult it remains for human beings to separate emotion from decision-making. When money, identity, and future possibility become emotionally intertwined.